Hey, welcome back to Wall Street Silver. Ivan called in sick today, so I got to do our intro today. I have here the amazing economic ninja and Adam Taggart from Wealthion. Thank you for joining me, guys.
Hey, thank you so much.
Hey, it's a pleasure to be here.
So we are all going to be in New Orleans, October, I think it is the middle of October, 12th through the 16th for the New Orleans Investment Conference. Adam's going to be uh, moderating a panel that the three of us are going to be doing on social media, precious metals, and what's going on in the world. And so everyone who's wants to join us, the three of us will be there. The link is in the description. And I hope to see you guys there. We'll have a beer together. But on to the topic of today. I wanted to get you guys on to talk about this. We normally talk precious metals on Wall Street Silver, but there's a lot of things that also impact precious metals. And one of those right now is interest rates have been rising dramatically. And there's something, Travis, that you were talking about where there's a disconnect right now for let's call it the repo market for automobiles. And so walk us through on what you've been observing, and then we're going to dive into how this connects to precious metals.
Perfect. So I get the question all the time when it comes to gold and silver investors. They are always saying, and they've been saying this for the last 10 years, why hasn't it just exploded with all of this money printing, all the QE, the stimulus, and so on, right? Why hasn't it exploded? And I said, everything changed with the invention of the computers. But really what you need to look at when you're talking about economic cycles is the psychology of the human being. What's going on in the mind of the human being? Do they have a wealth effect? Do they believe that the economy is strong and it's going to get stronger? Or do they believe it's weak and it's going to get weaker? And that affects their everyday purchasing. And it's been very well proven that the wealth effect from a high stock market is nowhere near as good as the wealth effect from a high real estate market. Now we're starting to see that turn. When we're talking about the car market, we saw something that we have never seen in the history of this world since the first automobile was built by Mr. Ford. And that was that you could actually buy a car, use it for a couple of years, and sell it for a profit. And that was simply because of a massive supply crunch. Now what's happening is a lot of people were given stimulus money. They bought cars they should never bought to impress people they don't even respect. Then they found out they can't make those payments, whether it be because of unemployment or because of lower employment, like underemployment, and then they had to give them back. And right now we have some of the highest repo rates in our country's history. I believe the last time I checked was 8,000 a day. We could go to these repo lots and see a lot of beautiful brand new cars with paper plates, still never even held long enough to get the plate. Here's the problem. The banks have taken those back. They are now trying to sell them. The bank is going, we got to recover as much money as possible. We do not want a large write-down. So they're putting them on the floor of these auction houses, and they are literally going from the beginning to the end of the auction as the car rolls through, and you're not seeing a bid, you're not seeing a bid, you're not seeing a bid, and the car is going down. Why? Because the bank set a price that's too high. It's too high for the small and large dealers that want to sell used cars, and they're going, we're not getting as many people rolling through the door to buy a car because they're getting hit with inflation from an energy, from gasoline, food, and so on. They don't have the money to pay for these expensive cars, and they're going back down into the yard. Problem is the bankers are very confused. They're in that eye of the storm right now where they went from a hot market to an absolute, they're about to see a collapsing market, and they think they can get X for their car. They're going to find out after a few months of carrying costs, they're going to have to start to drop these cars. And that is the psychological effect that happens in the housing market and in the precious metals market. But the precious metals market is much larger.
So interest rates have risen dramatically, right, Adam? And is there some sort of disconnect happening where the sellers have not yet adjusted to the higher interest rates, bringing down the potential? There's that thing in the housing market where as the rates go up, we see the buying power of what you can purchase for a home drops, payment-wise drops dramatically. Is that the disconnect we're seeing here?
Well, absolutely. So I think you've got a chart on this, Jim. The cost for owning a mortgage has jumped by like 40% over the past year. Mortgage rates have more than doubled since a year ago, August, and that just mathematically. There's no ifs or ands or buts about it. Mathematically, that has to begin to bring down home prices, and we've not seen home prices adjust according to the math that the actual mortgage amounts, the necessary mortgage payments demand. So there's still just this future mathematical correction that needs to happen in the market. But of course, the humans that actually own these assets don't want that to happen, and they're still living with the magical thinking of maybe something that'll happen that lets me avoid this, right? So just like as happens in the car markets, with the banks aren't admitting to what's happening in reality right now that Travis just talked about, same things going on in the housing market, where what you see listings begin to start piling up, right? Houses used to sell in a day with multiple bids and all cash bidders. That's beginning to evaporate in most markets right now. And then what you'll see is people start pulling inventory because they don't want to sell yet for a lower price. They just think, maybe if I go sit on the sidelines for a while, I can ride out this lull and come back in and sell my house for the price that I want. Now, as we know is going to happen, you sort of mentioned the coyote on a cliff, the roadrunner, the coyote runs off the cliff. He hangs out there in the air for a little bit before he realizes that gravity is going to set in. That's kind of where the housing market is right now. And in all of these markets, there's sort of a first mover advantage. And you'll see what'll happen is with home sellers is somebody's going to panic and bolt and say, look, I don't think prices are going to do well going forward. I think they're going to start going down. I may as well list my home for 5 or 10% below market so that I can at least get 90 to 95% of the value. And once that starts to happen, that's like a crack in the dam bursting. And then everybody starts chasing price downwards. So we're, I think, right before that period in the housing market. And honestly, I think we can make even a similar analogy in the jobs market right now, where we're being told by our central planners and the administration that this is the strongest job market we've ever had, when really companies are already beginning to shed workers. It's not the flood it's going to become yet if we truly go into the recession that I think you, Travis, and I think we're going to get. But it's that similar denial of reality where earnings the economy is slowing down. Companies are disappointing on earnings and revenue left and right. They're not going to be able to employ as many workers going forward, but they're holding on to those workers still because companies are slow to hire. They're slow to fire. These employees were expensive to acquire. They don't just want to let them go yet, but at some point they're going to realize, to save myself, I'm just going to have to start shedding costs. And I think we're just about at that point as well, where they're praying they don't have to, but I think reality is going to step in and force their hand.
This is one I just tweeted out the other day. Twilio, the CEO, announced 11% employee cuts, and they don't want to admit it's because of whatever reasons. But I love these reasons that they're coming up with to not look bad about their layoffs. He's going to do it for being anti-racist. I don't know if that's implying whether he thinks some percentage of his employees, 11% of his employees are racist, or what the reasons are. But you're starting to see companies make these excuses for why they need to do layoffs, and we're starting to see those types of headlines regularly in the media now.
Yeah. So to the point that Travis was talking about here, in your point there, Jim, it's like it's beginning to happen. We're beginning to see the cracks form. We're beginning to see the water start to shoot out of the dam here, but they're still not ready to admit it yet, right? Oh, no. It's not because our performance is bad. It's because we're putting some sort of social agenda on it.
Yeah. Well, it's not because we're in a recession. We're just going to change the idea of what a recession is.
Yeah. Well, that makes a good point. I just saw that GDP Now was just released by the Atlanta Federal Reserve. So the Atlanta Fed GDP Now, this is sort of what people consider the best predictor of what the next GDP report's going to be. Just a few weeks ago, they were, they always start out really optimistic early in the quarter. And then as you get closer and closer to reporting real data, it seems to just go down. And this was over 2% just a few weeks ago, what they were predicting for GDP for Q3. They just lowered it again to now it's only plus 0.3%. It was last week 0.5. I'm going to guess that by next week, this is down to 0.1%. And then as we get into October, closer to actually releasing the real number, like I say, it's looking negative, looking like we're third quarter of negative GDP. So my question is, it used to be 2 quarters of GDP negative growth, or negative numbers for GDP equals recession. Are they willing to admit it after 3 in a row? or are we going to keep redefining what a recession is?
Can
So
I speak to this?
Yeah,
All right,
sure.
this fires me up. So first off, revisions are the oldest game in the book. And this is what I lived through, not only in 1999, 2000, getting ready for the dot-com crash, but also in 2006 to 2008. What they do is they give you a number to give you hope, and then they tell you the truth a few months after it was supposed to be reported. And that's what we need to be focused on. It's very similar on the flip side, where a Fed governor will come out and publicly give an idea. Oh, the government should allow more money printing to be able to stimulate the economy over here or over there. And what happens is they try and measure the reaction from the community, from the citizens of this country. And if it doesn't incite some kind of craziness, they go for it. And I lived through this when Ben Bernanke was on CNBC in 2006, maybe almost 2007, with Maria Bartiromo, when she was saying, do we have a housing crisis? You know, I'm hearing a lot of rumbling on the streets. We have a mortgage-backed security crisis. And he goes, I really don't see what you mean, or I don't understand your premise here, because we've already handled the issues at large. And by the way, housing can and it's never corrected all at the same time across the country. And this is the game they play, these revisions. And this is what's really scary. The facts are a recession is defined as 2 quarters consecutive with negative GDP growth. That is it. There's no changing it. If just because an administration wants to change it because they want to spin it, like you just said earlier, Jim, they're trying to kick that can down the road. They're trying to put it. They're not going to admit it, because I'm going to be honest with you. I'd be shocked if we see another 3 months with data, real data, before the equities markets roll over.
Yeah. Adam, what's your thought when you look at something like this?
I agree with everything he just said. Just to be a little fair to the Atlanta Fed here, this is a formula. So the ninja's right. If you listen to what central planners or the administration tells you, they obfuscate, detract, distract, and then obviously disappoint at the end of that. The Atlanta Fed is basically it's a model that gets updated as data reports come out throughout the quarter. The problem is it's garbage in, garbage out, right? And a good deal of the data points, especially the early ones, the big jump there above 2% early in the sequence there, that was when the latest payrolls reports came out, which, really was just, I think, Jim, you and I even talked on that last time I was on your channel. It was just unbelievably difficult to square that data with all the other data that we're seeing there. And of course, as more data comes out, you were seeing a truer sense of what economic growth is, and it's showing that the data is worsening here. And you guys are right; we're likely to see a third contracting quarter here for 2022. Now, what's important about all this is exactly the point that Ninja's making here, which is, the markets to date have been able to remain in magical thinking land, thinking that it's not going to be as bad as it could be. But to use our Wile E. Coyote parable again, the coyote is off the cliff. He's now looking down and saying, okay, you know what? There's no way I'm going to avoid the pull of gravity here. And then that's when reality kicks in. And I think literally a third contracting quarter of GDP, we're not going to be having media discussions about the technical definition of recession. Everybody is going to agree that we are in recession.
I agree.
Well, that raises the point. If we do have this, and that number, I think, comes out in late October, and it will measure July, August, September GDP data. And if we do have a third quarter in a row of negative growth, gold and silver investors are like, as soon as the Fed pauses and stops raising rates, that's when gold and silver are going to take off. So does the Fed keep raising rates in the face of all these layoffs, an undeniable recession? Does the Fed say, screw you people, we're still raising rates to fight inflation?
The Fed says all day long they're data driven. They are not. They are results driven. When it comes to this interest rate raising policy, the Fed's up against a hard wall or a rock, whatever way you want to put it. They know that if they don't raise rates, and they're not aggressive enough to get over inflation to stop inflation, but they know that they've got to build that perception. We're trying, just like in December. Oh, we're gonna raise rates to beat down inflation 3 months from now. They're trying to give you a perception that they're doing something. The problem is they can't pivot until the equity markets or the bond market or something breaks. When that happens, then they have the right to pivot, because now it's not our fault. We've got to now react to the problem. And so that is exactly what happened. People don't remember this. The Fed, the repo window opened in, October of 2019, after the interbank lending rate spiked to 12.5%. When Lehman collapsed, the Fed repo window didn't open until that next January. To give you an idea of the scope of what happened in 2019, right? The collapse started in 2019. They are reactionary. They want to tell you they're data driven, but and I completely agree with Adam, the Atlanta Fed, they're going based off of data. The problem, the data has been corrupted for so many years, like the CPI, because of a change in their metrics, and it's not real with what's going on in the street. And so that's the problem. So yeah, they're putting out these reports, but their metrics changed and they're having to go back and revise. And so what we see is a Federal Reserve that is actually reactionary instead of proactive.
Yeah, I agree. I will say the folks that I have been talking to recently, my day job is interviewing multiple experts a week on what's happening in the macro side. They feel that things are a bit different this time with the Fed, that the Fed is really playing at this point for credibility. And it's funny to have the words Fed credibility leave my lips in the same sentence.
Yeah.
But I think that the Fed is really realizing that what's different this year versus the past decade plus is inflation, right? Finally have runaway inflation that the Fed has been unable to contain. And the Fed, I think, rightfully has woken up to the fact that says, look, if we can't get this under control, then the shreds of credibility we have left are gone, and then things get really outside of our control. So we have to do whatever it takes to get inflation down. And interestingly, Powell, he's a different animal than he was a couple of years back. We had the Powell pivot in 2018. Everybody came into this year so certain that the Fed was going to pivot sooner than it has, because Powell's got a glass jaw, and Powell is standing really firm. I just found out the other day, he actually threw away his original script for Jackson Hole to go with the short, tough medicine, where he basically said, hey, folks, it's going to require pain for both households and businesses to get inflation under control. That's basically the closest a central banker will ever come to saying, I am actually going to cause a recession to tame inflation, right? Yeah. So I think we have to, at least in the near term, bank on the Federal Reserve, or give a higher probability to the Federal Reserve continuing to hike for as long as it can, and to have the economy and thereby the markets suffer, in the near term, for the Fed to try to get inflation under control. Will they succeed? I don't know, but I'm placing odds on the fact they're going to give it the best try that they can. Now, to your point, Jim, about what that means for precious metals, I'm going to hand it back to the ninja here, because I know he has a thesis about this, which is once the markets really wake up to the fact that, the Fed no longer has our back, the Fed put is no longer near where I thought it was, and we have a fast contracting economy that's barreling into recession, that's maybe going to be compounded by issues in the banking system as these bad auto loans go down, the housing market rolls over, companies start laying people off. That's when we're going to see the capitulation in the markets. And Ninja, I think you've got a sense for how precious metals are going to fare kind of in a two-step process through that. Is that correct?
Yeah. So actually, unlike the Fed pivoting right now, I'm going to pivot right now, because what you said is absolutely correct. And it is very vital. Like when you have the Federal Reserve Chairman saying you're about to experience pain, because the Fed right now needs unemployment to actually rise to be able to justify some of the things they're doing and to be able to cool down this economy. And there has never been a better time to go and be around like-minded people or learn from people like Adam, like wallstreetsilver, and so many more that are going to be at this event we're talking about, because you need to have the tools to understand not only where to invest, how to invest, where wealthy people are investing, because what is about to happen is not only going to be a travesty, quite frankly, in the economy, but it's also going to be one of the greatest opportunities in life. And this is akin to what happened to gold and silver prices in the early 80s, well after years and years of inflation took Paul Volcker to the point where he said, I have to do something, I have to do it now, and it's going to be drastic. And Paul Volcker knew that he was going to create pain, but ironically, nobody ever talks. They hail him as a hero, but they never talk about what it did to the real estate markets. And when mortgage rates spiked in the mid 18%, that point took real estate prices and dove them down. Historians don't really record what happened, and it was so fast and so sharp. It was pretty impressive. It only lasted about 6 months to a year. I used to read when I first started buying real estate with no money down in the year 2001. It was because I was reading books from 1984 talking about that span of time. And like Adam says, the Fed has just told you you're about to experience pain, and that is going to come in many different ways. Currency devaluation, unemployment going up, small to medium businesses being affected, but that also means there's great opportunity. So that's why I don't want to preach the book or preach the event, but that's why you want to be around like-minded people, not only to understand that you're not alone, but also what tools do I need in my toolbox mentally to be able to deal with this.
So gentlemen, that was awesome. I've learned a lot just listening to the two of you. And we're all going to be in New Orleans in the middle of October. The link is in the description for anyone who wants to join us. The three of us are going to be on stage on day one, right at the beginning of the conference. And thanks for joining me here on Wall Street Silver, our channel. And I'm going to buy you each a beer or a glass of wine or whatever.
Nice.
When we're in, not the whole audience, not everyone. Yeah, I'll buy
just us, me and
first rounds on Ninja.
Adam.
And anyone who shows up in New Orleans with us will be in the bar.
Oh, you're gonna regret that, Jim.
Thanks.
Cool. It's been great. And I've been to this conference. This I don't know, it's going to be my 6th, 7th year or whatever. It is a great time for all the reasons that the Ninja and Jim mentioned. But there's one of the best collections of just macro analysts in the world that show up for this thing every year. So folks, hope to see y'all there. And Jim and Ninja can't wait to share a beer with you guys.
Can't wait, guys. Thank you so much.